This is Exchange Traded Fridays brought to you by ETF.com. I'm editor-in-chief Kristin Myers, and I'm joined today by wealth management editor Jeff Benjamin and research lead Kent Thune. Now, we've got a full episode for you today. We're going to be discussing the conflict in the Middle East that has kept markets under pressure and sent energy prices higher. We'll also be breaking down those port strikes and their possible impact on your portfolio. And then we'll be chatting Schwab and its share split on 20 of 33 of its ETFs. We'll be discussing that and what it means for you. But before we begin, I want to share some good news. ETF.com has launched subscriptions. All subscribers will not only get the same great content they've come to know and love on the site, but will also get added benefits from additional newsletters, members-only webinars, early access to tools, and more. So if you're interested, be sure to check out ETF.com/subscribe. So first up, let's start with those tensions in the Middle East. I figured I'd give a little bit of context. We already know that there is a lot going on right now between Israel and Palestine, and Iran this week decided to get into the mix after Israel killed Hezbollah chief Hassan Nasrallah. Now, we heard Iran decided to take vengeance on that attack and fired several missile strikes against Israel. Now, we already know that when there are tensions in the Middle East, energy and oil tends to be the things that react the most. And boy, did it ever. While we did see markets under pressure this week, even today, we are seeing them again kept a little bit muted because of those increasing tensions. We have seen the energy and oil ETFs picking up. I was just taking a look at some of the charts for XLE, that's the Energy Select Sector Spider Fund, and it has absolutely been performing incredibly well just over the last week. And this is pretty interesting because over the last month, it has been fairly under pressure. But literally just starting a couple of days ago, it has taken a complete about face and is now actually hitting some of its highest levels, I would say, going towards its highest levels in the past 3 months. Now, for anyone who is interested in investing in energy ETFs, I should also mention that though the recent tensions have definitely increased the prices on these ETFs as of late, we do have an oil supply glut, meaning an oversupply of oil, which has actually kept some of these prices actually a little bit muted. I actually think that we probably would have seen a little bit more of a pop and more of a rally if we didn't have so much oil floating out there, or these supply concerns of this overproduction. I don't know if you guys have been kind of watching the news and what you guys have been seeing, particularly with some of these ETFs. I mean, looking at USO, that's the United States Oil Fund. I should mention some of these are futures, while some of these ETFs are actually invested in the oil companies, but they have actually been soaring this week. Kent, I want to kind of just bring you in because I know that, well, you're our genius for all things, as I've decided to dub you, even though you are our research lead. And I know you've written a little bit on commodities and on the oil ETFs this week.
Yes. I happened to write this week on, oil ETFs and what we're talking about with the Iran and Israel escalation. So far, the major assets in Iran haven't been hit, at least as of this moment when we're doing this podcast. Who knows, maybe today or tomorrow, but most of the escalation in price, along with the escalation and the attacks there, is coming from the speculation. Investors tend to buy oil and oil ETFs during periods of geopolitical conflict, to hedge against risk of rising oil prices. So it's really just kind of a self-fulfilling prophecy. The fear itself is just driving speculation and making the prices go higher. So we hope that the violence and the attacks will calm down and no major assets will be affected. In that case, then prices would have a genuine reason to go up and then go even higher. I mean, as we speak, which is around the middle of the day, Thursday, oil is up 4%. You're going to be able to track the price of oil better by commodity-based oil ETF like United States Oil Fund, USO, and like Kristin mentioned, some of the equity-based investing in the companies, if you will, the energy selects spider ETF XLE is a good route to take. But yeah, it'll be interesting to watch this. The price of oil is just going to be moving on this story as investors are watching it.
Hey, Kent, are you? So, I mean, to me, it's a no-brainer that oil prices are going to spike in something like this happens. It seems like, it still feels like to me anyway, that the other shoe has yet to drop. I know with Iran sending bombs over to Israel, it seems like the other shoe, but it still feels like the tip of the iceberg as far as the uh, the conflict over there. Not to bring too many metaphors into my little statement, but I mean, seeing oil prices climb during this period makes sense to me. But are you suggesting that if things calm down, oil prices will continue to climb?
Yes, I mean a good analogy. I live on the eastern coast and South Carolina. I mean we watch hurricanes. Let's say a hurricane is approaching Texas where there's oil fields. The price of oil can go up on pure speculation over the concern that the oil fields there'll be disruptions there. So it's similar over there in the Middle East where you have rising tensions. Rockets being fired. Investors worry that actual assets, oil fields or whatever, there'll be disruptions there. There's also, it's a major shipping area as well, the Straits of Hormuz, where any of that's, we're going to see more of this phrase a lot more, supply chain disruption that we heard back with COVID. Anytime shipping routes are blocked or we have a slowdown in production, we're going to see prices go up. But at this point, Jeff, to answer your question, it's really speculation and concern over that actually happening. It hasn't, but the price of oil is being driven up by the concern over that.
Yeah, I would actually say one of the really big questions is going to be what the oil cartel, that's going to be OPEC and OPEC plus, decides to do over the next couple of months. Because as I mentioned, we already have this sort of supply glut right now. And I think that that's probably why we haven't even seen a bigger spike in some of these oil prices. Though, as you're mentioning, Ken, you're absolutely correct that the production supply fears have definitely kept some of those futures prices and those crude oil prices on the rise. But if OPEC decides, which they already had decided, to essentially cut production or reduce production going forward, if they continue on that path, I would say that we're probably going to see some of those prices spike even further. Now, we have already heard from President Biden, who has said he would not support Israeli attacks on nuclear capacities in Iran, and Iran is an oil supplier. And so, again, we do have this glut right now, but again, will we always have that sort of oversupply of oil? I think that really remains a very big question. I think we're all going to be watching to see what OPEC does decide to do, because again, if they do decide to remain on this path of cutting production going forward, I can only imagine that those oil prices are really going to pop. Now, if they decide that they are going to not cut production and actually perhaps increase production, we might see some of those gains perhaps again become a little bit more muted. Because again, if you are if you're on ETF.com and you decide to pull up, just XLE or USO, as Kent has mentioned, or BNO, again, that's the US Brent oil fund. If you look at their performance just over the last couple of months, and of course, energy is volatile, so it always tends to be on a bit of a roller coaster. But over the last 3 months, it has been under pressure. I mean, BNO down over 11% in terms of its performance over the last 3 months. It is no different when we take a look over at USO. And then when we look over at XLE over the last 3 months, down about 1%. Again, XLE doesn't just incorporate oil, but also has other energy companies that are a part of it that are able to kind of at least mitigate some of those losses that we've seen, particularly in oil. But again, I think a lot remains to be seen going forward. There has been attempts, and we've heard a lot about we're trying to avert wider crisis in the Middle East. And so we'll have to see exactly what happens over the next couple of weeks if those tensions continue to ratchet up, if OPEC decides to cut production or not. And that'll definitely impact some of those commodity prices. Quickly, before we turn over to some of those port strikes, which has of course been consuming some of the headlines over the last couple of days, I would also say what's interesting here, what will be interesting to see, is also the impact on the broader market. We have seen broader market ETFs really under pressure over the last couple of days. SPY has been under pressure over the last couple of days because of those fears. Again, that's the Spider S&P 500 ETF trust. It has sort of been barely holding on around flatline for the last couple of days. So broader markets have also been under pressure as well.
Exactly. I mean, I can add to the supply chain disruption conversation I just brought up a few minutes ago. Harkening back to the COVID days, unfortunately, we know all too well what that means. So, and that is higher prices for goods. Right now with the dock strike, we already have slower movement through the Suez Canal and the Red Sea. Now, if we have the shipping docks blocked up on the United States East Coast, I mean, that is just a fuel for fire for inflation. And that's why we're seeing a lot of rate sensitive ETFs decline in price. And we're seeing treasury yields go up. We're seeing consumer ETFs like the consumer discretionary ETF XLY, consumer staples ETF XLP. They're declining faster than the S&P 500. And that's concern over the supply chain disruptions and the inflationary issues that come along with that. So yeah, you can see consumer good prices go up. Not to shed light on this or make light of it, but we're already seeing people going to grocery stores and stocking up on goods because they think that there's going to be a supply chain cutoff. And again, going back to COVID, people are stocking up on toilet paper.
I have heard about that. The long lines of people just snatching up all the rolls of toilet paper and trying to get as many things of milk and other food. I saw bananas might be impacted by this port strike going forward. So just a lot of people stockpiling lately.
Right. And it's all inflationary. And so then if we're talking about the impact on ETFs and impact on the market, I think it's broadly and indirectly going to push prices down on everything because inflation is bad for stocks. Inflation is bad for bonds. I mean, you hear me talk about TLT a lot, the iShares 20-year plus Treasury fund. It's considered a long-term bond ETF. They're more rate sensitive. I mean, TLT price has gone down about 3% over the last month. It was down, I think, about 1% yesterday. And so we have a little bit of tick up in the labor market strength in some of the reports we're seeing this week, but also with the supply chain disruption. I mean, it's all bringing back COVID nightmares and inflation coming up. So we're seeing these rate sensitive ETF prices going down.
What's the long-term likely impact of this stock strike, though?
I'm glad you asked. That was just about what I was going to ask, Kent.
Right. You're leading into an answer, really. It's there. There's probably not going to be a long-term impact. In fact, some of if someone wanted to take a little bit of risk and stick their neck out, betting that this is all going to go away in a not too distant future, maybe they would go in and buy some of the consumer ETFs. That's not a recommendation, but I mean, it's just a point. So if we think a lot of these fears, whether it's the dock strike, that I'm sure that's more of a short-term issue than the Middle East conflict. So yeah, I don't see this as a long-term issue. And there's a lot of political pressure around it as well with an election coming up. It just seems there's just going to be some kind of deal brought to the table.
So wait, you're actually optimistic that this strike is going to end pretty quickly? Because in an odd way, I actually think the election means that we might see this drag out for a little bit longer. Because we've already heard the Democratic candidate, right? That's Vice President Kamala Harris, but also President Biden has also come out and said that he's not going to interfere with the strikes because this would essentially be going against the union. So let's just back up for a second. We've got 50,000 members of the International Longshoremen Association. That's the union that's striking. That's 50,000 members of that union that's striking all up and down essentially the Eastern Seaboard. And I think I mean, I very much could be wrong. I don't have a crystal ball, but I think that there's a possibility that perhaps the White House, or at least the Democrats, are not going to want to get involved and they could let this drag out for a little bit. I don't know how long, but I think they might. And so a lot of folks are saying, hey, this strike could be one of the most disruptive sort of protests and strikes that we've actually seen in recent years.
That's a messy twist. I agree, Kristen. That and it's kind of ironic that if the Democratic candidate is looking to appease 50,000 longshoremen or maybe a broader union base at the risk of losing maybe all those people affected by the strike. I mean, I guess that's the bet they have to make. But I can't imagine a lot of people are going to be happy in November when they're voting and they don't have what they need to live their lives
Well, this is
because of a
where
political
politics and
bet.
finance, right, get intertwined because we say all the time, markets look past politics. They look past this,
Hmm.
right? And this is one of those times where, right, politics actually might start impacting well, obviously politics does impact the economy. I don't mean to say that it doesn't. But this is probably one of those kind of political tightropes that, the candidates are considering right now. And it could have that impact on the voters because of what's going to happen with the economy. Because to your point, if they do allow this strike to continue on, and the strike does continue on for a long time, well, right now, folks are stockpiling, and I don't think we're going to see any short-term disruption to our supply in terms of what we already have in our stores. Long term, the longer this drags out, it definitely will. I mean, let's just look over at autos, right? That's one of the sectors and industries that's really kind of being impacted the most. We've already seen General Motors has slid, Ford has slid. I mean, taking a look at those particular ETFs, so you're going to have BOAT, that's BOAT, that has been impacted. And today, even, it has actually taken a leg lower. Let me just pull it up right now. So that's the Sonic Shares Global Shipping ETF. I mean, it's not down by too much. It has been kind of hovering around the flat line, but down about a quarter of a percentage point, at least today. But that is going to be one of those ETFs that's definitely going to be impacted. So 1 month performance has been about 7%. We're probably going to be taking a haircut off of some of those gains um, from these strikes. And then you've also got FTXR, that's the First Trust Nasdaq Transportation ETF. That's down today as well. So there are a bunch of ETFs that are definitely going to be impacted. I think probably in the transportation and shipping and manufacturing sectors particularly. But again, I don't know if I'm as optimistic as Kent is that this is going to be over before we know it.
I'll make one quick comment on that. And sometimes I say, that the cynical answer is sometimes the realistic one. If we see prices go higher and people are noticing it, and there's in the news you're seeing empty shelves, that's going to push a deal at least more politically. The Biden and Harris would want to get something happening sooner than later if it's starting to adversely impact the economy. So I think that the unions are probably picking their time in a smart way to get what they want, because we're going to see prices go up, or we could, and if we do, then they could push a deal to the table.
I'm going to be curious to see. I mean, I don't want to take bets on something like this for sure, but it will be definitely interesting, Kent, to see, which side wins out. My cynical, if my cynicism is actually correct, or perhaps if your optimism is. Then again, it's going to be right about day 4 that we're in on this strike. So I mean, it's early days yet. Let's see how long it kind of goes on for. I mean, I haven't seen really strikes in my more recent history really go on longer than 2, 3 weeks at most. So
Right. Yeah.
we're gonna see how much this is going, how long this will drag out, and who knows, maybe I'm gonna have to go to the grocery store today and try to stockpile on some toilet paper or some or some food. I don't know. I mean, you've got me nervous now, especially
Right.
with all of those headlines that are out there.
Yeah, well, and well, like you said, it'll be interesting to watch, and hopefully it's over sooner than later, and we'll definitely be watching it and reporting on it.
I will say one thing about this. Both the energy segment that we talked about in this dock strike, this kind of lays the foundation for single stock ETFs. I know you can't turn these things around immediately, but so many companies, these ETF issuers, have single stock ETFs that are just sitting there in filing and waiting to be kind of launched. Many of them have been approved. They just need to roll them out because they're waiting for the right time. Those single stock ETFs, which are only a couple of years old, uh, I could see opportunities right there in some of these oil and gas companies or something like that. If people will bet on anything, as we know, and if you want to bet with a little juice, that this kind of begs for single stock ETFs. But fortunately, right now, I don't think there are any that are betting for or against any of the energy companies. It's all usually technology companies or really volatile stocks.
Well, I mean, tech is the reason the automation is why the port strikers are, well, the port workers, I should say, are striking. And I forgot to mention, so I'm just going to kind of harken back to it. I mean, what's happening in the Middle East is part of the reason why we've got XLE as our ETF spotlight of the week. So definitely go to the site and check that out to read a little bit more on that. But I know we now need to talk about Schwab. And Jeff, you wrote all about this week. So many people clicked on this article to read it. I saw that Schwab is doing a stock split about 2/3 of its ETF. So it has 33. It's going to be doing this to 20. Can you tell us a little bit more about that story and kind of walk us through it?
Yeah. Um, yeah, Schwab, they're the fifth largest issuer of ETFs. They have 33 ETFs, and they announced in late September that they are splitting the share price on 20 of their ETFs. The share prices, the splits vary from the the largest of them, or the largest share price of the split, is the Schwab US Large Cap Growth ETFs. Ticker is SCHG. The share price at the time of this announcement was around $104, and they're splitting that on a 4-for-1 ratio, all the way down to the Schwab International Equity ETF, ticker SCHF. Share price on that around $41, and that's a 2-for-1 split. Um, Stock splits it's basically for psychological reasons. I always think it doesn't change anything from a shareholder value. It's seen as a big marketing move. Smaller share prices tend to be more attractive to retail class investors. Some people say financial advisors like smaller share prices because it makes it easier for them to allocate into, I guess, smaller portfolios, smaller retail class portfolios. It really is nothing but cosmetic, but for some reason it just gets attention. And that's probably why Schwab did it. They knew it was going to get a lot of buzz, it was going to get a lot of attention, drawn to their their lineup of ETFs. It's I don't know, it is kind of a weird thing, but there's a couple other things came out of Schwab, or one other big thing. Their CEO, the Charles Schwab Corporation, their CEO, Walt Bettinger, has announced he's retiring at the end of the year, being replaced by Rick Wurster, the company's current president. So Wurster is going to be the president and CEO. Bettinger will move to the board. Um, this is all part of a transition for a maturing company, and I don't mean that in a bad way. Schwab is a big company with a big footprint. They In June of this year, they announced that Bernie Clark, their head of Schwab Advisor Services, was retiring after, I think, 25 years with the company, and 15 as head of the financial advisor business there. Clark was replaced by John Beatty, the chief operating officer. So it's just a lot going on at Schwab. It's always an interesting company because it's such a conglomerate that basically jumped into the space decades ago with discount brokerage, And now they've kind of got everything under the sun, and they've moved from San Francisco to Westlake, Texas. Kent, you've got, financial advisory chops. What are your thoughts on stock splits? Is it just cosmetic, or is there any real investment value there?
Well, I agree with you, and which is not a common thing, but I, I agree with you on that. Yeah, it's mostly cosmetic because it doesn't change the value of the underlying investment itself. You know, from an investor standpoint or advisor standpoint, I mean, it may make some sense where if Schwab doesn't allow for buying fractional shares, I mean, you can buy more shares. So if someone's dollar cost averaging into one of their larger ETFs, like their dividend ETF, SCHD, massively popular fund, that one had a 3-for-1 split according to your article. So,
Hmm.
well, look at what we're talking about. I'm also a SEO guy, search engine optimization. I'm looking at trending keywords. That's one of the biggest trending keywords of the last week, meaning a lot of people are searching that. They see the news. Oh, wait a minute. What's going on here? What do I need to know about it? And so that's one of the largest articles of the year for ETF.com in terms of how many people are clicking on it and reading it. So you did a great job of covering the news on it, but it's really Schwab and the share split. It's really, I mean, mission accomplished on the
Hmm.
marketing. They're getting a lot of people looking at it. So yeah.
Yeah, next to adding a pumpkin spice latte ETF for fall, I don't know what else they could have done to get this much attention.
Do you guys think that this is a retail play? I mean, to your point, Jeff, going back to what you were sort of saying at the beginning, that this was cosmetic. Do you think that this is something that they are doing strictly to appeal to mainly more of those perhaps retail investors?
I think, I mean, ETFs are, as retail as they get anyway. And as I said, financial advisors obviously love ETFs. It's kind of hard to imagine. I just have a hard time getting my head around the thinking behind a stock split. I mean, even if there's got to be some kind of small expense to it, the filings of it, and probably got to pay some lawyers $6,000 an hour to proofread your filing or something like that. And for what? I think what would be interesting is to kind of track these ETFs and see what maybe the flows look like over the next 12 months versus the past 12 months. That would be kind of an indication of whether or not Schwab's getting any bang for their buck beyond this, initial news splash. But I don't know. I mean, it's to me, I never understood stock splits unless we're talking about something like Warren Buffett, where they're, when things get up to be like $60,000 a
Yeah,
share or
Berkshire
something like that.
Hathaway's share price right now is absolutely outrageous. I actually own it in my own portfolio, and I hate looking at the how I own point zero zero zero
Yeah, yeah.
zero zero 1% of a
But see,
share
but
of
see,
Berkshire.
even that, because there's fractional shares, there's just no reason for splits anymore. I don't think. But obviously they do them. So, I got to figure Schwab knows more about their ETF business than I do. So,
I mean, I think you're right. I think it probably is psychological. To that point, I don't like seeing
mm,
0.0001% owning of a share. I mean, I think people are probably more inclined to say, "Oh, great, I'll go buy 5, I'll go buy 10, I'll go buy 20," right? And instead of saying, "Oh, I can only afford, you know, half of this particular ETF that I'm purchasing."
Yeah, I think I'm really into behavioral finance, and that would be another topic for this podcast. But a lot of investors think that a lower price it does say value, and I want to buy. I mean, look at penny stocks. Why do people buy penny stocks? They think they're worth more. If you buy a stock for 5 pennies, and it drops down to 4 pennies, you didn't lose a penny, you lost 20%. But there really is a psychological aspect of it, and there are people who want to buy stocks when they split. Uh, and if investors are buying the shares when they split, then it is kind of again a self-fulfilling prophecy. Whatever makes people buy maybe doesn't matter as much as the fact that they're buying.
all right. Well, I guess we'll have to follow that. Let's do that, Kent. Let's pay attention to the flows and the performance of we don't have to do all 20, but a couple of them and see if we have a story 6 months from now on splits work or they don't, or whatever. But in the meantime, that is our episode for this week. We thank you all for listening. I am Jeff Benjamin, along with Kristin Myers and Kent Thune. We want to remind you that we have subscriptions now at ETF.com. That launched on October 3rd. If you want to subscribe to ETF.com, go to ETF.com/subscribe. In the meantime, this is Exchange Traded Fridays, powered by ETF.com. Thank you for listening, folks.